so much for joining me for the Sane Crypto podcast, the first cryptocurrency podcast for baby boomers investing for retirement. You know, most people believe that crypto assets are too risky for the average investor. I believe the risk is in not investing, and that in fact, cryptocurrency may be the answer to new retirees' prayers. We're going to talk about that quite a bit in this episode. But the trick is to structure our investment so that if the naysayers are right, we don't do irreparable harm to our nest egg. But if the believers are right, we make potentially life-changing money that could catapult us across that retirement finish line. The Sane Crypto Mastermind is my signature program for those who want cryptocurrency type returns, but can't, won't, or don't have time to figure this all out and keep up with it on their own. If you would like to learn more, I'd encourage you to join my free online training, how a little bit of Bitcoin can make your retirement savings go a lot further, at sanecrypto.com/retirement. So, is Bitcoin a good investment? I was being interviewed on Jordan Goodman's Money Answers podcast the other day, and he asked me something no one's asked me before, strangely. He asked me, what makes Sane Crypto sane? And the answer is that Sane Crypto is about stripping away the emotions, about ignoring our prehistoric lizard brains and making decisions based on probability and logic, rather than fear, greed, and ego. Now, to understand why I think Bitcoin is not only a good investment, but an essential investment, you have to understand how I think about investing. My starting premise is that I have to invest. Everyone does. My job as an investor is to take money that I create from my intellectual and physical capital, meaning my work, and transform it into enough financial capital to live 30 or 40 years in retirement or more, without having to make decisions like, do I give my spouse the very best healthcare at the end of their life that I can, and risk running out of money myself? And I use that as an example because it's not hypothetical. I don't want to get sidetracked, but I'll tell you a very quick story about my grandmother. My grandmother was diagnosed with Alzheimer's in her late 60s. She lived for probably 12 years, I think. And like most Alzheimer's patients, required increasing levels of care. While when she was diagnosed, she had plenty of money. By the time she died, she was absolutely on the verge of running out. Literally, if she had lived another year, she would have run through a couple $1 million of her and have nothing. And so, fortunately, I say this, but fortunately, my grandfather had passed before her. Because can you imagine being him and having to say, as this goes along, and you realize, she did have the best possible care. She was able to afford that, fortunately, and even that is not great, But can you imagine being him and having and looking at that and projecting that forward and saying, do I cut corners for her and know that I'm not going to have any money left? We're talking about paying your bills in retirement, but we're also talking about the further you go, the deeper you go into your life, the more consequential, this money becomes. Okay. So, mathematically, to replace a $150,000 a year income and have a reasonable probability no guarantee, but a probability of living comfortably for 30 years in retirement will require a nest egg or starting assets of 1.6 million, just as an example. Okay? $150,000 a year income, low rate of inflation, 3.5%, 30 years in retirement, $1.6 million. And oh, by the way, if you would like to do these calculations for yourself and know how much it would take you to replace your income, I do have a free retirement calculator on my website. You can go to sanecrypto.com/retirement-calculator. You'll also find it up at the top in the menu. It says free tools. All right. So to do that is going to require, in addition to saving a meaningful portion of my earnings over time, a low double-digit return. Not all the time, because that's not possible, but over time, meaning my average over my lifetime, right, needs to be low double digits. Nobody tells you that. And the later that you start, the less compounding you'll get, of course. So the higher that average return will have to be to make up for that. So this is your job as family CFO of You Inc. And I would argue that it is the most important job that you will ever hold, right? Far more important than your W-2 jobs. And it's also a very hard job. And here is why. Number one, unless you have a crystal ball, which to my knowledge hasn't been invented yet, although I'm sure Silicon Valley's working on it, the future is a probability distribution rather than some fixed outcome that is knowable or predictable in advance. Okay? So, one, you are playing a probability game. Two, you are playing that game with a lizard brain, which happens to be hardwired over millions of years of evolution to be really bad at probability games. And for more on that, I'd encourage you to go back and listen to episode 31 and listen to my interview with former Harvard professor and author of Mean Markets and Lizard Brains, from whom I stole the term, Dr. Terry Burnham. Number three, investing is a zero-sum game, which means if you win $500, someone else has to lose $500. And you are playing that game against some of the brightest minds in the world, literally, who have unlimited resources, basically, unlimited money, unlimited computing power for the ultimate prize, which is money. And finally, as if that wasn't hard enough, the playing field is designed to disorient, distract, and deceive you. The financial press and nowadays social media is filled with propaganda and misinformation that acts just like the lights, bells, and buzzers on the casino floor. It is all a great system designed to part you from your money. But, lest you think it's an impossible game, it's not. It's definitely not, because the good news about this game is kind of like that old story. You don't have to run faster than the bear to get away. You just have to run faster than the guy next to you. Now, some people may think that sounds harsh. And it is harsh. But it is. But that's the game. And you got to understand it. Because the consequences of playing poorly suck. And your only other alternative is just to hope. And, hope is a very nice thing to have, but a terrible strategy. I have been working recently on an article that I'm pitching to a major publication about baby boomers investing in cryptocurrency. And for background, last week I asked my email list, if you aren't invested in cryptocurrency, but you're interested enough to be on my list and reading this email, what's holding you back? And the answers generally boil down, no surprise, to Bitcoin being, or cryptocurrency, whatever, Bitcoin, cryptocurrency being perceived by our lizard brains as being too risky, right? Think about it. It's volatile. It's unfamiliar. It's not mainstream. In the same way that we worry about mad cow disease, when 4,000 people per week die from the flu in the United States, by the way, that's known as the availability heuristic, which causes people to give undue influence to the news about hacking or Silk Road, or the Russians use it to pay for a server. I mean, these were definitely all things that that came up in the answer. Warren Buffett's partner, Charlie Munger, says, quote, "There is a lot to be said that when the world is going crazy, to put yourself in a position where you take risk off the table." So to me, the great irony in these answers, in these fears, is that Bitcoin actually reduces risk, not increases it. Really. Tell your lizard brain to go take a powder for a minute, and I'll explain. Bitcoin reduces risk in 3 ways. 1, diversification of your investments. 2, actually, let me go back. I should say Bitcoin can reduce risk in 3 ways, right? But of course, you have to actively manage it to do that. But anyway, okay, so 1 is diversification of your investment. 2, diversification of your money, which is not the same thing, by the way. And 3, optionality, or what you have probably heard me refer to as Pascal's wager. Harry Markowitz won a Nobel Prize in economics for what is today known as modern portfolio theory. This is going to get, slightly wonky, but it's really important, okay? So please don't tune out. The underlying concept, which was so groundbreaking in the 1950s, was the fundamental concept of diversification, right? You could argue that was the financial equivalent of Newton's discovery of gravity. And he only figured that out in the 1950s, if you can believe it. It seems like it should have been around forever, but it wasn't. And modern portfolio theory says that it's not enough to look at the expected risk and return of one particular stock. That by investing in more than one stock, an investor can reap the benefits of diversification. The biggest of those being a reduction in the riskiness of the portfolio. And, so this is just basically the idea, it's a fancy way of saying not putting all of your eggs in one basket. But what modern portfolio theory did is it quantified that, right? It proved it mathematically. It's economists do a lot of math. All right. So, taken further, people realize that, the same is true for different asset classes. And that by holding a basket of assets instead of just one, like stocks, right? And specifically a basket that hopefully go up and down at different times, which we call non-correlated assets, that you can optimize the return that way, right? You get the maximum return for any given level of risk. Now, that sounds really, really complicated, but it isn't. It doesn't have to be hard. People make it hard, but in a variation of Dr. Craig Israelson's 7 asset class portfolio, my investment firm back in the day often recommended a very simple portfolio for just, of like 20% stocks, 20% bonds, 20% commodities, right? Like meats, metals, grains, right? Energy, 20% real estate, and 20% cash, made up of ultra low cost ETFs rebalanced once a year. That was it, right? That is I don't want to say perfectly diversified portfolio, but right, it is, okay? And now, that does not make the investment advisors any commissions, and it's very hard to justify a high fee for such simple advice, which is why your financial advisor probably doesn't recommend it. But nonetheless, statistically, mathematically, over time, that portfolio is really, really, really hard to beat. All right, you with me so far on this diversification idea? Okay, well, the one fly in the ointment here is that over time, with globalization and instant information, all these different asset classes have become more and more correlated, meaning, they move together. They are affected by the same things or by one another more than they were previously. So what ends up happening is you think that you are diversified, but mathematically you really aren't, or not as much, which is where Bitcoin comes in. So correlation is a mathematical equation, and it's measured on a scale of 1 to -1, with 1 being highly correlated, meaning the assets go up and down together, 0 being uncorrelated, and -1 being negatively correlated, meaning that they will tend to move opposite to one another. The 3-year correlation of the S&P 500 to the NASDAQ, for example, is 0.95, not quite 1, but almost. Meaning, as you would expect, they are very, very correlated, of course, okay? The 3-year correlation of Bitcoin to the S&P 500, NASDAQ, gold, and Brent crude, it has been -0.01, -0.02, 0.05, and 0.01 respectively, meaning it is uncorrelated with all of them, and therefore provides awesome mathematical diversification to a portfolio, okay? So on that basis alone, adding it to the portfolio, right, reduces risk. The second risk pickup is in diversification of money. Now, I'm not an alarmist by any stretch of the imagination, okay? But I do have hope for the best and plan for the worst as a core financial philosophy, as I believe everyone should. So going back to episode 29 about buying Bitcoin as a hedge against political turmoil and financial crisis, there is anecdotal evidence at this point to suggest, based on what we have seen recently in other countries, or at least over the lifetime of Bitcoin, that Bitcoin does in fact serve as both a medium of exchange and a store of value when the native currency is collapsing. In that episode, I talked about not just Venezuela, but Zimbabwe. Right now, Argentina, theirs has crashed. Turkey recently, Greece, right? There's all these examples where we've seen. Now, one of the things, that, yes, that seems to be the case. And I think, and a lot of people think that will be even more the case in the future, because they're in those countries right now, the on-ramps, which is, when we say that, we mean like ways to convert the native currency to cryptocurrency. In all of those countries, barely exist, right? Here in this country, like Coinbase is an on-ramp. Gemini, Kraken, ones that will take US dollars in our case, or euros or whatever, and allow you to buy cryptocurrency with them. That's an on-ramp, okay? So those barely exist in these countries like Venezuela, Zimbabwe, etc. So, and still we saw, right, them act as a hedge and store value. So as those, it would be very reasonable to assume, of course, that as those on-ramps become more commonplace, you would expect to see more of that, not less. So in a world where, anything is impossible, that my grandmother, the same one I told you about earlier, used to always say, nothing is impossible, just highly improbable. It makes sense to me to diversify your money meaning that portion of your assets whose job is safety. Okay, so to me, the money, right, is you're not investing that. That's basically the cash portion of your assets. We call it cash, but it's not all cash, right? It's the safety portion, okay, as opposed to the portion whose job is growth or income. That's the investment portion, right? So to diversify the cash or the money portion by holding some of it in native currency, which for me is dollars, some in cryptocurrency, which for me means Bitcoin, and some in gold. And to take that one step further, I would say that at least some portion of that should be safe and accessible to you if the crap were to ever hit the fan, right? That's kind of the point. Not just to have it, but to be able to use it if you needed to. All right, so that's the number 2. So number 1, diversify your investments. Number 2, diversify your money. Number 3, the third risk pickup, which is the one you hear me talk about the most, is the outsized return potential. Quoting Charlie Munger again, he says, risk to us, meaning he and Warren Buffett, is 1, the risk of permanent loss of capital, and he emphasized permanent, or 2, the risk of inadequate return. Okay, listen to this, you guys. I know you've heard this, but to see it in one place is still quite staggering. The historical rates of return of Bitcoin have been 1,395% in 2011, 200% in 2012, 5,525% in 2013, then minus 59% in 2014, 36% in 2015, 124% in 2016, 1,307% in 2017, and now in 2018, year to date, we're down something, I think just north of, I haven't calculated it, but I'm sure it's over 60% right now. Oh, is that volatile? Yes, right? But when note that, Charlie Munger said, I said this before, said permanent losses of capital, not temporary losses of capital. Okay, that, yes, it's volatile, but that's the hardest thing for a lizard brain to grasp. Is that's okay. Especially the longer your time horizon is. And so, inadequate returns are, as I explained to you, when I told you the story about my grandmother, inadequate returns, inadequate assets are a massive risk, far bigger than the risk of losing a little bit of money, so long as you don't let your lizard brain invest too much. But that's not how our brains work. And that's what makes it so hard for us, right? There's an article by Trent Griffin about the work of Harvard economist Richard Zeckhauser, and he writes, David Ricardo made a fortune buying bonds from the British government 4 days in advance of the Battle of Waterloo. He was not a military analyst, and even if he were, he had no basis to compute the odds of Napoleon's defeat or victory, or hard to identify ambiguous outcomes. Thus, he was investing in the unknown and the unknowable. Still, he knew that competition was thin, that the seller was eager, and that his windfall pounds, should Napoleon lose, would be worth much more than the pounds he'd lose should Napoleon win. Ricardo knew a good bet when he saw it. What Zeckhauser is describing is what Michael Mauboussin calls the Babe Ruth effect. Mauboussin writes, in any probabilistic exercise, the frequency of correctness does not matter. It is the magnitude of correctness that matters. Even though Ruth struck out a lot, he was one of baseball's greatest hitters. Internalizing this lesson, on the other hand, is difficult because it runs against human nature in a very fundamental way. Okay? So my argument is, just to sum this up, Bitcoin is, in fact, a good investment, right? As Seth Klarman has said, the three best ways to reduce risk are diversification, hedging, and buying with a margin of safety. In spite of what our lizard brains would tell us, Bitcoin inherently checks two of those boxes, two of the three, and you can check the third by putting your lizard brain in a little box and not letting it out, no matter how loud it screams at you in fits of fear or greed. In fact, that is the very reason that the Sane Crypto Mastermind is helpful. The system puts your lizard brain in the box. In fact, that is the box. And then having accountability keeps you from letting it out when you are tempted. So, all right. So that was roundabout, went a little bit longer than I expected, but I hope, as always, that you found it helpful. If it was, I'm going to ask you to take a moment to do two things. Number one, to subscribe to the podcast. And number two, to leave me a 5-star rating and a review with comments and feedback like so many others have done. It really, really, really does help. It's all about the algorithm. Both of them are all about the algorithm, which I think in this day and age of algorithms, you all probably understand. Also, if you'd like to learn more about investing in crypto assets for retirement and my system for doing that, I recommend my free online training, how a little bit of Bitcoin can make your retirement savings go a lot further, at sanecrypto.com/retirement. You can get the full show notes of this episode at sanecrypto.com/podcast. And what else? Oh, if you have a question about today's topic or anything else, question, comment, thoughts, just email me at askhim@sanecrypto.com. I read and answer every email personally, as well as answer some of them here on the show. Everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That's it for me. I'm Kim Snyder, and I'll be back next week. Until then, may the crypto gods continue to smile on us all.